Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will talk about the January effects in stocks.
Hello everyone, my name is Radovan Vojtko, I'm CEO of Quantpedia. Today we will discuss calendar effects. So our world is connected with the yearly seasons. We have a spring, summer, autumn and winter. And we have our calendar in the West, in US, in Europe. We use the Gregorian calendar, which ends year in December, in 31st of December. And how we measure the time, it also has tremendous impact on performance of some strategies. It has such important impact that there are a lot of papers written about this effect. And one of the most important effects are the January effects. So the January is the first month of the year, and it has some important impact on the performance of some strategies. So we can try to look for the word January, and we can see that we have 4 strategies in Quantpedia, and I will show you a few of them, and I will also discuss how are the calendar effects present in other markets than in US or European market. So the first important strategy is January barometer. We do not consider this effect very significant because, in our opinion, it's a little speculative. What is this effect talking about is that we can use performance over the January as a predictor for the performance over the next 11 months of the year. So if the January performance is positive, then the next 11 months will be also the positive. And if the January month is negative or have a negative performance, then the next 11 months will be also the negative or with the negative performance. There is not very strong economic theory why the anomaly should be working. So we have, moderately strong or weak confidence in anomaly's validity. But auto-sample vector doesn't look very bad. So if we run the auto-sample test, we have at least positive performance, but the Sharpe ratio is not significantly better. But a good intro into January effects. What is another interesting or more interesting strategy is the original January effect. So what is the January effect in stocks about? So the calendar anomaly connected with the stocks with a small market capitalization. Anomaly itself is very old, is very widely researched, and is also very well known. The anomaly says that the return of the small cap stocks are particularly strong in January. The reason for that is once again connected with the calendar. So in December, a lot of the portfolio managers are closing the year and they are trying to show nice performance, or if not nice performance, at least they are trying to show in their yearly statements that they have companies that performed very well in the previous year. During the December, usually they sell out the small unprofitable stocks and they buy some large cap strong names like, Apple, Tesla, IBM, blue chip stocks. And in January, there is a reversal. So once again, the stocks that were sold in December, they outperform the peers. So in January, the small cap stocks usually outperform the large cap stocks. So what is the trading strategy? The trading strategy can be very simple. So we can invest in the small cap stocks at the beginning of each January, and we can stay and be invested in large cap stocks during the rest of the year. So that's a very simple trading strategy. We have another January effect, and it's directly the January effect and the mean reversion. So as I mentioned in the previous anomaly, in January, the stocks that are unprofitable, the small one, they perform usually very well. So we can build a mean reversion strategy, which will buy stocks that perform very bad in December. We can buy them at the end of the December and hold them for January. And we can sell short stocks that perform very well in December. We can short them during January. So that's called mean reversion, and especially in January, it's the strongest month of the mean reversion or short reversal effect in the stocks. As you can see on the chart, the performance is especially interesting during the last crisis years. So in 2021, in 2022, 2023. So 2022, it was before war in Ukraine, between Russia and Ukraine. In 2021 and 2020, these were the years with the COVID crisis. So that's also very interesting strategy. Let's move to some other market than the US or European market. It would be logical to expect that if these strategies are working or at least seems profitable in Western markets, maybe they are profitable also in emerging market or in Eastern markets. But what is important to know is that not all of the world uses the Gregorian calendar. So not in all of the world, New Year starts in 1st January. So in the Chinese market, the classical January effect is not profitable at all. When we want to apply this strategy to Chinese market, we must understand how does the calendar look like in China. So the China is using the lunar calendar, And for them, the lunar January usually spans from late January to middle March, and is different than the solar calendar that's used in the West. So when we change this strategy and we amend the strategy Chinese market, the strategy says that we should buy the stocks during the solar January or during the few weeks after the start of the Chinese New Year. And if we download the data and take a look on the performance, we can see that that's right. So the strategy is really significantly profitable, and it works especially well for the Chinese Lunar New Year. Thank you very much for your attention. I hope that you like this little journey into the world of seasonal anomalies, and I hope that you join me in the next video. Thank you very much.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.